My presentation regarding better decision making. And I'm going to take you through a little bit of a process on how I try to make my decisions on an intraday and let's call it intra-quarter swing trading basis. So without further ado, just a couple of disclaimers so we can get right into the material and get right to the goods over here. Welcome, everyone. It's very nice to see you and be here with you again today. A big thanks to David and everyone involved in putting this conference on. Anything that has to do with improving the acumen of a trader, a decision maker, an investor, I feel has a domino effect. Make better decisions for yourself, better decisions for your family, communities, and it ends up being a positive force. So the educational part of what I do is quite fulfilling, and I enjoy it quite a bit. And again, happy to share my time with you here on that. Just a couple more things that I need to take you through, disclaimers, and then we can move right into the conversation. Everything that I share with you here is meant as education and insight only. It is not a solicitation to buy or sell any particular security. I am a trader, I'm a strategist, I'm an analyst, I'm also an educator, and I've been doing this since about 2008 when my life took a little bit of a turn. On the heels of some family tragedy, I had to make some choices and move out of a climbing the corporate ladder career in CPG companies and selling a couple of family businesses or keeping them, running them, and continuing to work at corporations. I chose to sell them, leave the company, and actually start trading. Not necessarily the wisest decision right out of the gates, but it was a choice that ended up being fairly fruitful for myself. So what I'm going to say to you today is that everything that I'm going to share with you is not meant as go and do something. Why? Because I don't know you, don't know your risk tolerance, and I'm not a registered financial advisor either. If you are hearing me talk about future potential outcomes, results that could play out in the near future or later, well, they're hypothetical, they're forecasted. Of course, they're fact-based and researched, but they are not necessarily what will play out. Nobody has a crystal ball. No one can tell you what will happen. And of course, trying to understand what the better decision is for an individual trader is really about that individual trader or investor's risk tolerance. Now, obviously, this is one of those types of careers, endeavors, where you know you're right away, or you know you're wrong right away, if you're trying to make a decision for right away. If you're making a decision for a longer period of time, it really is about a choice of understanding how much risk one is willing to bear, and what are the undercurrents that a particular area in the market is likely to be undergoing. Is it more up, sideways, or down? Well, clearly in today's trade for equities, it's down. So we're going to start off with the current state of the market. And based on the number of folks that have responded back to me to let me know that they've heard me speak on Tuesday, I don't think there was enough. So I'm going to repeat a couple of things, but then I want to take you into a process. So current state of the market. I always like to start presentations like these where I'm not really familiar with everyone in the room with just an overarching statement. We are in a year where we've got a playbook coming from 2018. I wrote an article back in the beginning of 2018 to clients that were part of my active trader room or my online trading room at that time. And I titled it, Quantitative Tightening is Likely to Break Bad with Markets. Powell, new chair installed in the Fed, came in and decided to tighten up the Fed's balance sheet. What does that mean? They don't buy as much stuff and print money to buy it, meaning bonds. And they end up letting them expire, roll over, and they don't keep them in market. This effectively is a drain of the liquidity system for the biggest financial market out there, the US, which represents about half of all capital markets almost, in certain cases more, with about 5% of the population globally. Now, the blue line over here is that Fed's balance sheet. The yellow zone over here is 2018. The red line is the S&P. Quantitative tightening was announced leading into the end of 2017. And at the very beginning of 2018, we had the last hurrah for equities higher on the heels of crypto and cannabis rising dramatically. And it was a bubblicious type market. Everyone was shorting volatility. global manufacturing data points like PMI, Purchasing Manager Index type data. They're all coordinated green. Draghi was doing his swan song over in the Eurozone. And what happened was jobs data at the end of January came out a little stronger than expected, which effectively snapped something. It allowed the marketplace to go, oh, we may actually see them tighten faster than they have actually announced. And it created a little moment called Volmageddon. The shorts on volatility ended up blowing up, and we ended up seeing a fairly big down in the market. That was the first little red circle over here. Then the market actually rose, and we ended up snapping after the FOMC meeting on I think it was September the 26th in 2018, and we had red October after that. Powell effectively pounded the table on trade war, doesn't matter. US economy strong, labor market still has legs. We're going to tighten faster. And the market didn't like it. Now, we've already had the first move down on a very similar type playbook or similar type of undercurrents. The things that are different is inflation is moving at a much faster pace. The economy is not necessarily growing at the same pace that it was into the last round of quantitative tightening, or their attempt at doing so, which was back again in 2018. And we obviously have a geopolitical risk that is a little bit bigger than just a trade war. We've actually got a war. So we've had the first down, and the question mark that most folks are asking themselves headed into the May 4th Federal Reserve policy statement is, will the Fed overdo it, create a breakdown in the market, and will that incite a back away from tightening the purse strings type of event or job on it? Very likely is my answer to that. I think that they will overdo it. I think that we probably will see a 50 basis point rate hike on May the 4th. I think that we will see a little bit more of a sterner or aggressive stand. Effectively, they're going to come out and say that here's how much quantitative tightening we've announced, here's how much more that we can do, and we're going to be able to modulate that based on data coming in. They will effectively try to spook the market even further. When you're behind the curve and you're trying to chase something or slow something down, there's two ways to do it. There's the announce it and there's a reaction from the market. There's announce it again and add a little more incremental hawkishness, or there's announce it, add some incremental hawkishness, and then on top of that, surprise them with more hawkishness. And I think that's where we're headed on May the 4th, which is a moment in time where we could see a little snap in the market. I doubt it's going to be as big as the drop that we saw in late September of 2018 down to the December massacre of 2018, before they came in and said, hey, I'm going to be putting money back into the market. And effectively, literally the first week of January of 2019, Powell was flanked by Bernanke and Yellen on live TV, walking back all of his balance sheet normalization comments. And they flipped dovish. It's very similar to the attempt that Yellen had when she took the first rate hike in a whole bunch of years, December 16th of 2015. She had to walk that back in 2016, January, very quickly. So we're in an environment where we've seen this happen before. It creates an opportunity and a set of risks for active investors on multiple timeframes across a variety of asset classes. A lot of folks told me back here on Tuesday that they're focused on stocks, and a lot of folks are focused on currencies as well. So we'll try to kind of gear the process that I take you through to those areas. But this overarching theme is the dominant theme that drives my thinking and my decision making. And then understanding the math as we lead up to that a moment in time helps me kind of figure out the opportunities that I'm looking for, and that I can talk to members of my active trader room and the wealth charts community that I talk to regularly all about. So let's take this and let's resolve it with one very simple insight. Are you willing to put more money to work looking for higher prices in stocks ahead of May the 4th? Simple yes or no question. Just let me know in the chat, type in the letter Y if you are. If you're not, type in the letter N. Would love as much participation on this as possible so I can make sure folks' heads are in a similar spot or in a very different spot than where I would have assumed. So you let me know if you're willing to put money to work on the long side of stocks ahead of the May 4th Fed announcement. Or are you going to be waiting for that event, looking for some sort of a risk event to play out, and then using the moments after that, which, look, if it doesn't play out and we're going straight up because people get really hedged up like they did into the March 16th FOMC presentation, there was a moment right there that we had a signal, in the day or days after to look long again. But we didn't see that as a sustainable rise. In fact, we came to members of our active trader room community and said, so it's all fine and dandy that we can see this rise, but it's more about an unwind. It's about the institutional players that are faster money, call them hedge funds, active trading funds, unwinding positions and selling them to retail. They were effectively optimizing for bag holders, which they did. And there were a lot of bag holders at the top of that move. So when you take a look at the entire move, I'm not going to take you through the history of the market. I'm sure everyone's well versed in it. We made lows at the end of September last year. We bounced. And prior to that, we saw topping patterns in economic data for most of the world outside of North America, starting as early as June of 2021. We saw topping patterns in price for markets like the NASDAQ, the Russell, in November of 2021. From a personal portfolio standpoint, my strategy was to shift to the things that I need, not I want, especially in December of 2021. And I was looking for a correction a little earlier than most other shops were. I actually called it out and said, I think we're going to see something that's 10 to 20% down between Jan 15th and Feb 15th. And I bullseyed it on the January the 30th. Now, it came a little before that, a few days before that, obviously. We made the first lows on January the 24th. But we nailed that timing fairly well. And prior to that, we were really looking at a lowering exposure in things that were high beta, high sensitivity, low quality within equity land, shifting over to inflation hedges even more in terms of commodities like oil. And it was a wild ride in December, and shifting over to things like REITs and staples, utilities, things we need, not the things we want, consumer discretionaries, vacations, cars, et cetera, et cetera. So we got that strategy right. We moved into January, and we identified in January no real great reasons to be traders of stocks and swing traders of stocks in a big way. However, stocks that were linked to commodities, oil, natural gas, base metals, we called out trades like DBC, catch-all commodity tracking ETF out there, USO, UCO for those who are playing with leverage. We looked at copper, we looked at agriculture, DBA, DBB, and January to now was better because of that. And of course, we did actually call out a long VIX trade at the very beginning of January, which worked out, and we had a duration of about a month on that, and it worked out very well. Now, where we ended last week was right here. And what we told members of our active trader room in the Wealth Charts community is we're likely going to remain in this box into May the 4th. If we're going to be breaking down below the bottom of the box, which you can think of as around $430 on the SPY, 4,300, about 133 points lower than where we are right now on the S&P E-minis, breaking below this area roughly would be something that is not expected by me. It can happen. Don't know what will, but it can happen. But the threat of nuclear war didn't keep us below it for too long either. So, and that happened in the midpoint and latter part of February. So where we are right now is a market that has gotten more hedged and more, let's call it scared, and is willing to pay a little bit more for insurance of prices falling down. We still haven't broken the bottom of the box. We're at a spot right now where we're still holding, in and around this area quite nicely on the S&P 500. And even despite the move down in the market today, we haven't actually broken down to a lower low for the week, despite what Powell and company had to say earlier this morning. So when I look at this market, I came to members of the active trader room last Friday and I said, I'm looking for a swing low formation in the front half of this week. We made that statement and had trade ideas associated with it last Thursday, reiterated it on Friday with the condition of, I think Sunday night is likely going to be a little messy. And then between Sunday night, Monday morning, we probably see a transition. The transition took all of Monday and then confirmed on Tuesday. And then we made that little move up in yesterday's trade, but we weren't able to really push further. Our target for the week was 44.88 to 45.26 on the S&P. The reason I'm telling you all of this is in order for me to work you through a swing trading process from here, which I'm going to get technical with you on that, I need to understand the about 50% of the equation that I'm going to be working off of. So the directional equation for stocks, typically North American large cap stocks, and you can extrapolate this to the global stock market overall. If we get the market risk and direction right, we've got roughly half the equation of which way things are going to go on our side. Then we've got to understand all of the things that are tethered to the market, like currencies, fixed income, policy, events, themes or trends of a variety of asset classes within equities even, and get a good sense of how those things are working with or against an up direction or a down direction in equities. Now, we know dollar rises, negative correlation for the market in general. Typically, when we see the dollar rise, we don't see precious metals rise, but what we've seen through this geopolitical crisis is precious metals have risen with the dollar. And of course, they've all been positively correlated with oil as well. So when we think about what we want to play inside the equity market on, figuring out risk first of direction over the course of minutes to hours, days to a week, and then weeks to let's call it 2 weeks out for now, because May the 4th is going to be an important day. Figure out that directional risk and the odds of it, and then move to which areas have a better chance of doing better or worse. And then, of course, drilling it down to an individual play. My wheelhouse is focusing on the 80% of the equation and then using algorithmic tools to get me down to an individual, and scanners getting me down to an individual security. So you can think about market risk and direction as the direction of the river. Is it north, is it south, or is it standing still, going sideways? You can think about the sector or space as a squadron of ships, and you want to be with the squadron that's got a better chance to win a battle, and then you want to be on the ship that's got the least chance of having a hole poked in it and has the most gas in it and the best staff and crew to keep it at the front of the pack. That's the philosophy that I would employ. So we know that the current direction in the market today is down. That downward direction has not ended yet. Technical signals that I'm going to introduce you to in just a moment. I'll just give you a quick peek of that. On a daily chart, a 4-hour chart, and a 1-hour chart are all set up right now, telling us that we still have more downside risk. It's not done. But if we start looking underneath the hourly time frame, which can tell us a little bit more about the immediate term now, we've gotten to a place where we are so overcooked to the downside that there's going to necessarily be oversold bounces that play out. One can take advantage of them on a day trading basis. I have today. I've traded again today, and green on the day again, which is nice. And just some day trading, shorting the S&P E-minis, using a suite of tools. And I'm going to take you through that imminently. What I want to make sure that's seated with you, though, is what I'm going to take you through can be applied to intraday trading, intra-week trading, intra-quarter trading. And this is the cornerstone of what we want to get at. Are we seeing the market in a spot where it's got a better chance for up or a better chance for down? And what are the things that are tugging at it that'll help us understand which areas to play with it? So without too much further to do, the answer to the question is we are actually in a range-bound market. It is no longer trending. That's hence the box on the screen. The range core has been about 9% in size, from the 468-ish area down to about the 430 area on the S&P. We use the S&P as the barometer for that directional risk because it's the index that most folks have their eyes on, and in fact is used as a benchmark, for performance for funds. Are we doing better than the market? Well, are we doing better than the S&P or not? And this is, pretty much everywhere in the world. So when we look at the market today and move into what's happening right now, I'm going to take you there right now. Let me just actually exit the slide. It should be on your screen here. So there's the live market chart for the SPY right now on my wealth charts. And what you can see very clearly is the same thing you were looking at on a slide, but this is the actual live ticking price. There's a retracement on here. Going back to the highs of January the 4th, lows of February the 24th. And yesterday we poked above the halfway marker, but we did not close above. As a modest technical signal, that's negative. And it was not negative enough for us to look at it, for those who are in my fold looking and in the wealth charts fold, we were not negative enough on it to say that it's going to tear the market down. In fact, we had a positive outlook for Tesla, but we very simply said the risk-adjusted decision maker that played the swing low formation in the front half of the week out, either by looking long the SPY, looking long one of the individual sector trade ideas that we put out, or day trading on the long side up until yesterday. Any of those folks, excluding the day traders because they were flat at the end of the day, our thought was, selling into strength makes sense. Tesla's likely going to see a beat, and that beat, I had a target earlier yesterday of around $1,137. I'm actually not sure how high Tesla got today, but I don't think it clipped all the way there. But bottom line is, Tesla was positive enough to keep things buoyant pre-market. And get us even higher in that target zone that I provided members back on Thursday last week. Last Thursday, I came out, and in print, I provide reports, and they're all recorded, so it's you can't make that stuff up. Bottom line was we were looking for a target zone of 44.88 to 45.26, and we got into that zone quite nicely. We were not looking for the market to go higher than that. We were looking for the market to pull back from there. And when you look at the action right now, we are below that 50% retracement line, but we are still in a swing low formation. Now, how many folks know the basics of swing trading? You go there and you go, what constitutes a swing on a chart? Doesn't matter what the time frame is. Obviously, there's nuances, but how many folks actually know what the definition of a swing is? Okay, and this is not a silly question because I ask it and I find that most folks don't actually know how to define it. They're looking for an indicator to tell them whether we're in a turn. But if you don't have the basics of reading the chart on your side, it's going to be difficult to utilize anything that enhances that. So I'm not seeing too many answers in the chat right now, so I'll just give you the answer. There's lots of things that you can go to. Bulkowski's got candlestick patterns, Steve Nissen. There's so many chartists out there. John Murphy wrote the Bible, technical analysis of financial markets. And make it really simple. You have a down, you have a pause, it could be a reversal, and then you have an up. Okay, that's the shape of a U. Could be a V as well, and this could be on a minute-to-minute basis, hour-to-hour, day-to-day, week-to-week. And it doesn't have to be 3 bars, 3 weekly bars, 3 daily bars, 3 4-hour bars. It could be more than that. If it's more than 5 or 6, we're looking at something else going on here. You haven't figured out what that pattern really is. The bullseye pattern that one is looking for a swing trader is actually what happened in the market from Thursday to Tuesday. So we have the down. Okay, we have the down in a week where pretty much the entirety of the week, except for Thursday last week, were in this kind of inside day format from really the second or third day last week. We did not actually break out or break down. We kind of went sideways, okay? Thursday was a little more expansive, but not enough to actually raise alarm bells. So my call on Thursday was we're likely going up after a little dip on Sunday night. And we saw the dip. Monday did not go up as fast as I was expecting. I was expecting us to, land well above 44.08 on Monday. It happened, but in after hours. So I can't take any claim of victory on that. Bottom line is, you got the big candle down, you got the indecision, pause, slightly lower lows, but some traction in the lower half of the range of the down candle. And then the third bar, at minimum, has to close above the halfway marker of the first red down bar that marks that 3-bar pattern. That's a swing. Okay, now that swing has to be kind of characterized. Is it minor or is it major? So you have to look at the asset class itself and kind of get a sense. what are major, what are minor moves. Minor moves on the S&P are anywhere between 1 to 3%. Major swings are between 3 to 5%. Everything bigger than that, after a bigger move down in the market, more than 5%, is a different type of move. Okay, now it can also be a swing, but it has to be characterized a little differently. So we're in a move where we've come from highs back over here at the end of March, and those were around the 460 area for the SPY, down into the 430, 435-ish area over here, into the end of last week, very beginning of this week. So we're in the area of a minor swing, and in a minor swing that's contained within a market that I've already kind of proven out to you using just some lines drawn on a chart here, that we're in a box. What does that minor swing look like as far as where and how much it can return? Well, it's a swing within a box where if you're in the upper half of the box, white paper math and pattern would tell you you have a better chance to come closer to the top of the box. So we've got a 9% range, chop that in half. Okay, so we get from where we were, 4 or 5% higher. We're probably getting what we want out of that swing. Now, there's obviously going to be nuances, but you now have a framework to think about what we're in. We had a swing low that took us above the halfway marker of the overall retracement towards the halfway marker of the box itself, but not much higher. And now we fizzled out over there. So if you take a look at the live chart again over here, the highest point of the SPY, open high, low, close numbers are up the top left over there. The high was $450. Okay, so we effectively hit the center of the box and have been rejected. Now, do we know, and is someone going to come to you and say for sure the next day is down, the day after that is down, and this is not going to be able to recover? No one has a crystal ball. So we have to have some probabilities around this, and we have to whittle that down to, meaning whittling the uncertainty down to get to a place where we can make a better choice. And we're going to take it from the basics of, a Fibbo retracement, understanding of swings, to learning a little bit about these moving averages that are on the screen and a couple of the subchart indicators, to quite a bit more detail in just a moment. So the process first is market direction. Then I need to understand what the market's tethered to and how those things are moving. And then I have to understand, using some math that an algo can do for me, which individual ship should I be in. And I want to figure out the market direction on the squadron that I want to participate on quite well, using some basics and a little bit more fine tuning. And then I want to have someone else, i.e. a computer, pick the actual ship to ride on. Of course, we want to vet it too, but we'll go through that process. So we are in a swing low that has not been fully destroyed. Okay, today, the retracement, the break above the 50% retracement, hitting the halfway marker of the box around $450, and then getting rejected over there. And you can argue it's because of X, Y, or Z reason. We can actually define the reasons, right? We can actually go into a day trading template over here, and we can go, well, what actually got knocked down? What were the asset classes that pulled the market down? What was the internal structure telling us? I don't think that that's going to be extraordinarily useful at this stage of the analysis, but at this stage, what you know is that the down that's happened here, it's not good that we're below the halfway marker of that overall retracement. So insight number one, if this swing low that was forecasted last week to play out in the front half of this week is to continue, a clean signal would be closing back above the halfway marker of the overall retracement. That would imply there is room to move up. Can we confirm that with some of the basic indications that are surrounding price? Forget about candlestick pattern, chart pattern, or all that. It's just, are we above the halfway marker of the retracement? White paper math says the odds are more likely to say we keep going higher. Now, let's add to that, okay, if that plays out, and we also incorporate these three little moving averages. They're linear regression averages, taking the closing price and then looking back on the gold line over here, 7 days, blue line, 14 days, and the red line, 21 days. Now, what would constitute a signal enhancement to closing above $445.31? Having not only the 7-day, but the 14-day linear regression average above the 21-day. So it would require a dragonfly doji type candle to present prices to come back up to where they started the session. The opening for a red candle is at the top. So we need to see that, okay? That would be a complement, an odds enhancer. Okay, now I want to go down to the bottom of the screen. I want to look at two basic indicators, the Fisher transform and the modified RSI. It's an RSI that has a linear regression average added to it, and it can work as a crossover signal. But what I'll say is, if you're looking for, for the musicians in the group that listen to, orchestras or symphonies play out, you can't do it with one flute or one trumpet or one percussion instrument. It requires a lot of instruments together to make the sound and make that kind of music. Similar type analogy in markets and using technicals to analyze charts. The main reason we do this is we want to reduce uncertainty, and it almost always relies on past behavior that contains patterns to project what's going to happen right now, likely, and what may happen in the future in a variety of time increments. It ends up becoming a self-fulfilling prophecy the more saturated a set of tools are. And it kind of raises the waterline. You have to have certain things on your chart to understand what that decision point looks like. So I've got the basics on the chart right now. I'm not using the 50-day moving average or the 200-day. I've got those on other charts as well. There's a lot of lowest common denominator tools that have to be there. And then there have to be a few things that are just a couple of notches above that. And then we can fine tune it even more. But we want to get about 80% of the way there for a directional signal at a market level right now. So I can say very clearly to you, if we rise today into the end of the day, close above 445 bucks and 31 pennies, and it is complemented by the 14-day linear regression average pushing up above the 21-day, the 7 days already above, we have got very likely well above a 50% chance for the market to be in an upward move into tomorrow's open. Then we have to consider tomorrow morning. We're getting Eurozone manufacturing data starting at, I think, at around 2:30 a.m. or 2 a.m. We get retail sales from the UK. And then we get manufacturing data from the rest of the Eurozone and total numbers as well. Most would be expecting misses or poor performance. So there's an opportunity to beat and surprise. And the interesting part is because most are already expecting a disappointment tomorrow, that's already priced in. So if the data does disappoint, it's not necessarily going to cause a big disturbance in the force. It would have to disappoint by a wider margin. So tomorrow, let's assume today we get a reversal, we close above the purple line, price action has risen fast enough to allow the blue line to get above the red line and the yellow line's above both of them. And we've got better than 50% odds that'll just go up off the chart. The event tomorrow is data. And the interesting part of the data, if you model it out, you try to become quantitative about it, which I do in spades, and I've got my own tools in the background to do that. It'll tell you that if we get slightly weaker prints on the PMI from the Eurozone tomorrow morning, it's probably not going to make a big dent in the euro. If we make anything more than a 2 standard deviation miss of the consensus estimate, we probably will see a bigger disturbance. So it kind of leans to a double-edged sword that cuts nicely either way. And it leans to the data can come out poorly and not affect risk sentiment dramatically, not hurt the euro dramatically. And that in turn could actually support the dollar flattening out and pointing down. And that in turn can support a variety of other assets on the other side of the dollar, like the S&P, stocks. It also happens to be something that can pull yields down when the dollar comes down. So what I'm saying to you specifically is case one, we rise, get above the purple line into the end of the day. Let's assume a trader is in a swing trade on the S&P and has not let go and bought it last Thursday, bought it this Monday, bought it on Tuesday. Yesterday was not a buy day. You can look at it however you want. It was just not set up as a buy day. It was set up as a sell day, or at least a pause and hold and have some risk management. And where we are today is really about one that may not have taken money off the table yesterday on short-term swings. Days to a week is short-term for me. Is today the day that they have to take money off the table? Well, stops are probably tripped on many. If not, you've now got a case closing above that 445.31, and also seeing that linear regression crossover positive. We've already got the Fisher transform in an oversold state and bouncing. That's already a check mark. That can support the swing continuing. And this modified RSI, just the nominal value of the RSI, if you look at it, is not in an extraordinarily overbought or oversold state. And it's in a positive crossover state. You can argue divergences, sure, but it's all good to go. So case one, if it happens, what I'm saying to you is my research says the data tomorrow is less likely to create a disturbance in the force and can actually keep the euro pointed up from its nascent start of pointing up, which really comes from the Bank of Japan, defining what it's going to do with its buying programs this week, which effectively has put a floor on the yen and a ceiling on the USD JPY, and can effectively help the long bond in North America. Not necessarily to a great degree today, but it effectively can make that transition. So what's the other case? Let's imagine we close exactly where we are right now. Okay, would you buy that candle and buy the SPY if that was the only thing you could buy, and you were completely flat and you had to put money to work? Would you be confident about putting all that money to work the way that we present right here? And that's very simple. Very simple. You can just type in the letter Y, or you can type in the letter N. I'm not sure if I can type to you in the chat or not. I was just trying to put a breaker in there. Yeah, so I just put a breaker in there. So you let me know. Is this a spot where you could see yourself putting money to work if we close just like this? My answer would be no. But my answer would be I would be on the ready. Why? Because I have not seen today's price action come down and actually tear down more than half of the confirmation candle of the 3-candle swing low pattern. So if we were below the halfway marker by the end of the day, call it $441 and change on the SPY, there's no good reason for me to look long. It's more just about short or letting go of positions until the market sorts itself out. Okay, now, can I do better than that? Well, yes. Next part of the process. Remember, we're going through a little process over here where one can imagine that it's get the market direction right, okay, which is half the equation. Figure out what's tethered to the market, what are the events that are upcoming in the more recent time frame, like within the next 24 to 48 hours, to help us with the individual sectors. And then let's use a software that is very specifically tailored to help us with the individual ship that we'd want to ride, long or short. Okay, so let's get a little deeper. The next part is let's take the concept of reversion to the mean. I taught a little bit about this on Tuesday. I'm not going to teach about it today, but it's a bell curve concept. Now, we're looking for a data series that is distributed normally. Now, if you look at markets, most will say that there's skews, there's fat tails, and we're not normally distributed. But then why do we turn around when we get 2 standard deviations away from the norm more often than not, either from the high side or from the low side? So you can go back and check it yourself. You can actually see it for the prior month, March. We got very close to 2 standard deviations away from the VWAP month to date at that point, and we started to pull back. So where are we now? Well, this little lime green line is about 1 standard deviation away on the Qs below its month to date VWAP. Have we made the lower low? No. Are we starting to see the ship try to turn? We are. Okay, is reversion to the mean a higher probability when we are 1 standard deviation away or 2 standard deviations away? The more standard deviations away, until you get into 3 plus, the higher the probability of mean reversion to start in. When you have moves that are 4, 5, 6 or higher sigma, something's broken, right? And it's a new normal that's forming. Even up to 3 standard deviations in most cases, actually, from what I can see looking at any type of data series, we tend to normalize. We tend to want to revert back to the mean. So we're in a spot right now where it's 68% of the time we stay down here and start to revert back up. Okay, we're not far away enough to say that it is a very high probability, but I like 68 better than a blackjack table. Okay, let's go and do this for the S&P 500 as well. That was on the Qs. This is the SPY, and the SPY is not even all the way down here and has broken above in today's trade and yesterday's trade the center of its volume weighted average price cone month to date. It's not above the center, but note what the number is for the center. $445.47. Go backwards to that line that I showed you over here. What's the center of the retracement? What's case one if we are able to see that present? Okay, the if is now going to turn into, okay, what's the more likely outcome using a suite of technical tools in just a moment. But what I'm trying to take you through is, hey, if we get the case of getting above there, see a couple of the other things, we're in a spot still where we could see continuation higher. Now, we've also added to that the idea of reversion to the mean. And from the standpoint of the market that is the more stressed one with yields rising at a faster pace of late, like it did in Q1 of 2021, and even more so this go around, is the NASDAQ. And the NASDAQ's at a spot, as we've just mentioned, where 68% of the time it would stay here and try to revert back up, okay? And the S&P has shown more promise, driven by having sectors that benefit when things are a little scarier for those that are taking on risk. But it too has come down. It has not come down to make a lower low. It has not come down far enough to signal reversion. But what it has on its side is proof in the pudding, better behavior. We're in a spot where the insight I can give you against both of the VWAP cones is the Qs are likely going to stay within that two-thirds of the time, roughly. They stay within it. That's the case here. And the SPY has had better traction and has not come down far enough to say it is going to be magnetically attracted to the next level, i.e. $437 or $38 or lower. Now I can take that even further here, and I can add a suite of technical tools. Now, for those of you that attended the recent Wealth 365 Summit, you would have heard Mr. Rob Hoffman come out and tell you, hey, there's a whole bunch of new indications that he's been able to add in to those that subscribe to Wealth Charts with annual memberships. And then he gave everyone a great price on top of all of the great value that already is in there. Now, what I've got on the screen over here is a slew of technical tools that were added in that come with a membership, an annual membership on Wealth Charts. So there are things like the Rob Hoffman Breakout Forecaster, Champion Trend, Wealth Charts Breakout, Wealth Charts Signal for long or short, Rob's Institutional Reversal bar buys and shorts, and there's also an adaptive trailing stop that's added in here. I haven't put it in right now just for convenience of and ease of going through this presentation, but that's also in there as well, which is a pretty cool tool on top of everything else. Now, the part of the conversation we're at right now is I've given you a case that can imply, hey, we could continue higher. And I've given you a case where if we close below X, Y, or Z number on the SPY, halfway through yesterday's green-bodied bar, we're not really looking for that positive continuation. So market direction based on two cases with defined criteria now is going to turn to, I turned to reversion to the mean, which was something that was a positive more so than a negative on both fronts, the S&P and the NASDAQ. Now we're turning to a suite of tools that are unemotional, don't require interpretation, just description of the signal. So we're going to use that on two different time series, on what's likely to happen for the balance of the day, and then where are we in the swing structure of the market? What's the signal? So divide this chart into two, halfway through the screen, okay? On the left-hand side of the screen, you've got a 4-hour chart, a 1-day chart, each bar is a day, and each bar over here is a week. On the right-hand side of the screen, you're thinking more about what's going to happen for the balance of the day, the rest of the afternoon. And what we're looking at is the synthetic S&P E-minis, which is about 7 handles higher than the actual E-minis at this moment in time. So if you look at the right-hand side of the screen, you're thinking more about day trading or directional outcome into the end of the day. If you're looking at the left-hand side of the screen, you're looking at days to potentially weeks or months even. So let's start with the bigger time frame. What does the weekly chart say? We don't have to interpret it. What does it actually tell us? We are in a sell zone. The weekly chart says this is probably not a great place to get long. Is there more definition over here that we can utilize? Sure. Okay. Where would the sell zone break? Well, all the way up here, that's not going to be very useful. What's useful, though, is we are in a sell zone. Okay, we're not in a spot right now that says this is a great moment in time for investors that make allocation decisions over months, quarters to years to accumulate assets at a market level, at an equity index level, which is about direction for the entire river. Okay, not individual stocks, the entire river. And when we take a look at the daily chart, what does it say? We're actually in a buy zone. Okay, Do we have definition right now where that buy zone may end? Well, it's quite a ways away. It's all the way down over here in the mid 4300s. So if I was quarter to quarter, that might be tolerable. If I was week to week or day to day, for my liking, that would not be tolerable. I would not want to see 80, 90 to 100 points down on the S&P. Now, it depends on the individual trader's risk, of course, and their tolerance. Bottom line is, this might be tolerable to someone. A couple of percentage points is, not a hard thing at an index level. But if the suite of stocks that one was holding, the weighted average beta was like a 3 or a 4, okay, it's not just 2% down, right? It's 3 or 4 times that 2%. And that might end up being something that's not tolerable. Everyone has to make that choice on their own, of course. Now, the signal is, if I was holding long from earlier this week, I don't want to get out of the way. What have I said to you? If you understand the basics of price reading, have we seen the price action of today's red candle take out the halfway marker of yesterday's confirmation bar of a swing low? Not yet. Okay. So the independent technical toolkit over here, including champion trend, breakout forecaster, wealth signal, the wealth signal breakout signal itself as well, and a couple of others in there, is saying that this is still a hold the long on a day over day basis. Okay. And where does it cut it off? In the mid 4300s. I get down to the 4-hour chart, which is really more about the day or days ahead up to a week in front of me. And it still says I'm in a buy zone, but I extend it all the way down to the very bottom lip of where it would have turned into, it's not a buy zone anymore. So I've got definition from the technical tool, which paints in advance and stays as is. Okay, it doesn't change around. Bar's closed, its line is flat, it's closed. So when you look at the signal over here, it says, well, we don't really want to see prices come down on the this version of the S&P E-minis below 44.29, 44.28. Take 7 points off of the actual E-minis today. If it does, what does it open the door for? It opens the door to confirm what the 1-hour time frame signals and under are telling us right now. So the 1-hour chart is in a sell zone or short. Okay, the 5-minute chart is in a sell zone and has not broken back out above the upper lip of the sell zone, which would be around 4,447, 48 on the S&P E-minis. We're only 13-ish points below that right now. But if we were to get above that line, perhaps we are seeing something change. So if I wanted to get long this market on a risk-adjusted basis, meaning eliminate as much of the uncertainty that we're actually in a turn, I would at minimum want to see price action on the S&P E-minis 10, 12, 13 points higher than where it is right now. And if that so should happen, great. But I don't want to counter trend trade. I want to take the signal that we're in right now and just be aware of where that signal goes away. And that would be effectively at the top of this band over here. We're not there yet. Now, do I have a leading indicator right now that tells me, am I going to come up to the top of the band and break it and have a change in signal structure into the back end of the day? Not as of yet. I've had some moderation of the negativity on the 1-minute chart. I've got a 1-minute chart under my head over here. You can see it right there when I take my head off the screen. And what it's effectively telling me is there may be a change of foot. So I'm on alert. I have a number, okay, that I need to see price get above, and that's where I would kill my shorts if I was short as a day trader. And I would consider that there may be a turn in the day that could then get me back to what's my 2 cases. There's a turn in the day and I'm sustaining above a particular number on the primary market, roughly 44, 48 on the S&P E-minis and holding. And I'm only 9, 10 points below there right now. I can start considering not to lower further any exposure I might have long on the market. And then look for confirmation into the end of the day of price actually getting above that purple line, closing above a few of the other doodads that I just put in there, along the conversation. I want to see that those boxes ticked off as well. And then, of course, I want to go in and say, hey, am I starting to see reversion back to VWAP for the SPY? Am I back above it? Well, if I'm above it, obviously I'm above the 50% retracement marker. So that's a positive signal. I'm not there right now. If I'm looking at the market that's kind of carrying the bigger directional stick on the day, Was it able to hold -1 standard deviation from VWAP? Was it able to get above another threshold? If those boxes are ticked off, okay, all is good. Why? Daily chart still says I'm in a buy zone. 4-hour chart still says I'm in a buy zone. So I need to see a change in signal. Now, most of us that approach equity markets after careers, I had a corporate career, ran businesses for my family as well. And when I changed my career to trading, I thought I knew much more than I actually did. I knew nothing. I knew less than nothing, negative. And it hurt me in the beginning. So I didn't have a process that worked, didn't understand psychology. And I was always trying to be very discretionary about my decision making rather than mechanical. And I was not willing to accept a set of signals and accept their instruction, if you will. So the instruction right now is no longs. Right now, we may be seeing a transition. May is not a trade. The signal right now is if I was short as a day trader, and I've been shorting throughout the day today, right now I'm flat to do this presentation. But as I've been shorting throughout the day today, I think I can bring up a dome here, maybe. I don't know how well. Actually, I'm not sure if that's appropriate here or not. David, you can let me know. I can bring up my trade from the day, a couple of scalps on the ES. They're not live right now, but they were taken today. You can let me know if that's appropriate or not.
Yeah, you can show that if you want.
Yeah, sure. Okay, so I'll just bring it up on the screen over here. So that's in one account. It's just a small account. Okay, and this is just trading with 1 or 2 contracts. And then I did it another way, because I like to show people that you don't need to use a full contract to trade the ES. I'll bring it over here so you can see more. So this is, I'm not saying that this is typical. I'm not saying that I do this every day. I'm saying that this is what I did today, earlier in the day. And that's it. I'm making no claims about, consistent results or you can do this, anything like that. I'm just letting you know that I took the signal. I didn't fight it. Okay. And as well, you can look at it over here. I did this with the MES, so micros, rather than full contracts, trading 5 at a time. Right. So just to help folks kind of see that this can be done. It's not going to work out all the time. And most folks that day trade actually lose. Okay, just understand that. But what I wanted to prove out to you is I was able to be green today. I took the signal, I took the plan that I had, I took the structure of the signal on the hourly chart and under as my day trading go-to, if you will. But then the swing trades that I may be in, well, do I want to take them all off the table? Some would have to come off the table, but has the market actually given me that full turn down? The answer there is no, not yet. Now, I'm going to continue this conversation with members of the Active Trader Room later today and, of course, tomorrow. And we're actually in the middle of a 2-day class over at BBT, BecomeABetterTrader.com, and Wealth Charts right now. The second half of the first day is happening right now as I speak. So I've just kind of left there to be with you for that. And I'm on tomorrow all afternoon. But what I'm going to do, because we're getting closer to the end of the presentation, ask you 2 questions. Number one, okay, we didn't get to the stage where we can, go all the way down and get down to the scanner itself. But what I can tell you is if I get that upward signal, okay, and I get that signal into the close that says the market tide is actually turning up, okay, well, I'm not shorting anymore, and I'm looking at a swing low type trade between tonight and tomorrow. Is there an outsized amount of risk with the data coming out? Yeah, there is. But I'm going to go run it through a slew of scanners and configure the scanners appropriately to find the right ship to ride if I want to play that upside. Now, the beautiful part about the tools that I just introduced you to, and I didn't even really scratch the surface on my day trade template and this tick tool over here, which is in a transition now itself. Which is supportive of a bottom forming in the market rather than the bottom falling out for now. Okay, so I'm very cautious about looking at shorting further unless I break the lows and i.e. break down below that 4-hour bar low. But if you like what you've seen and learned something here, type the letter Z in the chat to let me know that. And what I'm going to do is make you a very quick offer here to join me and join Wealth Charts. It's a value that you're not going to see anywhere else. The layout that you've just seen me use, except for the ones with some of my proprietary indicators that were on this this template and some of Rob's marketplace indicators, which are on this place, everything else that you saw is available with an annual membership for Wealth Charts. And you can do this on a monthly basis. You don't get all of the good juicy benefits with that monthly, but the monthly is available, and it's at a significant discount, and it's today only. That's it. It's done. We reintroduced this special just for you and for David and the Tech Whiz conference, and it goes away after today. It's $97 to join. You can hear me speak every day in the morning, pre-market setups. You can hear me speak every Tuesday on wealth charts. And if you want to get all of the layouts and all of the indications, not only can you hear me speak every day, get all the layouts, get those indications, except for the marketplace ones, which I showed you just a moment ago, for $970 on an annual basis. And you can jump into the class that we're doing and watch all of the pre-recorded classes that have been done. I think my first class was done back in December 2019, which breaks it all down step by step. So if the quality of the education, the insight, and some of the signaling that was just provided to you is enticing to you, well, jump on over. Very simply, you go to getwealthcharts.com. As you go over there, you'll see this page pop up in front of you, and you'll note very clearly that the price is there for you for today. You'll see all of the incredible value, and I've only scratched the surface of the type of value you can get here. It's all available and there for you to read through, and today only, you've got that price at $97 a month or $970 for the year. And you get the benefit of jumping into that class with me tomorrow. You'll also hear my partner in crime, Lori, speak tomorrow morning, who focuses more on options and really gets into the weeds on individual stocks as well. And you can see that that price is $970 for the year to join with all of that. David, thank you again for inviting us over here. I hope that everyone enjoyed the presentation. And I'm looking very much forward to the next one with everyone here. I'm looking to see you over at Wealth Charts, perhaps even for this afternoon. All right, folks, we'll leave it right there. And David, I didn't want to take the next presenter's time at all today, so I'm going to flip the screen directly over to you. And again, big thanks for your support and for everyone's attention during this last hour or so.